Welcome to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, here's this week's market wrap with commentary and analysis from the low-cost precious metals dealer voted best in the U.S., Money Metals Exchange.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Coming up, we'll hear an eye-opening interview with Craig Hemke of the TF Metals Report. Hear from the man who accurately predicted a year ago that 2019 would be the best year for gold and silver since 2010, and we'll hear his new call for 2020. Craig also takes some serious issue with some gold naysayers and perma-bears and calls them out for being blinded by their agendas. So don't miss my conversation with Craig Hemke coming up after this week's market update. A wild week for markets as the U.S. and Iran came to the brink of war before both sides apparently decided it would be wiser to pull back. After Iranian missiles hit a U.S. military base Tuesday night, gold prices surged above $1,600 an ounce. As gold headed toward a 7-year high, even the mainstream media had to take note. Jim Cramer and his fellow stock market pumpers on CNBC took time to lament the fear-driven buying of gold.
All right, Jim, what's caught your attention this morning beyond Citi in terms of the key to this market? Obviously, we see, broadly speaking, a down market.
Gold. You know, when I see this endless buying of gold, it makes me think, for the first time, maybe people are just saying, I am really fearful. It's not just treasuries. The gold buying has been endless, Dave. Over and over and over. There are only a few growth gold companies. The main one is Agnico Eagle. People want to buy. That's the one to buy. But it's relentless, and it feels like gold wants to go to 1,700, 1,800. You know, that would be very negative for the market.
Yeah.
Fear buying of gold and other safe havens ended up being short-lived. After U.S. officials reported there had been no casualties and Iran stood down, fears of World War III suddenly turned into hopes for a quick end to hostilities. Wall Street celebrated as metals markets sharply reversed midweek. As of this Friday recording, gold is now relatively flat overall for the week to trade at $1,560 per ounce. The silver market shows a slight weekly gain of 0.2% to bring spot prices to $18.16 an ounce. Platinum is off 0.4% since last Friday's close to come in at $982. And finally, palladium pushed through the $2,000 level for the first time ever. It currently trades at $2,129 on the heels of a 6.5% advance this week. Well, while we can take comfort in the tamping down of tensions between the U.S. and Iran, it would be naive to believe that the threat of further conflict in the region is over. It appears that Iran was in fact responsible for shooting down a Ukrainian passenger jet. If it instead had been an American Airlines jet loaded with U.S. citizens, we'd likely be seeing much more of a reaction from President Donald Trump and perhaps our military forces as well. Iran or Iranian-backed terrorists could be planning other forms of retaliation as I speak. The assassination of Iran's top general has stoked extreme new levels of anti-American resentment. It won't abate anytime soon, especially as the Trump administration is vowing to impose tougher economic sanctions to punish Iran. America is also struggling to keep Iraq from forging closer relations with Iran. Iraqis increasingly want U.S. forces out of their country. Democracy in the Middle East never quite works out the way the foreign policy central planners in Washington envision. After so many years since 9/11, after so many trillions of dollars invested and ultimately wasted in Iraq and Afghanistan, President Trump at this point is looking for an honorable way to cut our losses. But his neoconservative advisors still cling to grand notions of remaking the region in our own image. And the pull of the Israeli lobby and military-industrial complex is perhaps the most powerful force in Washington, D.C., as all presidents come to learn. Of course, precious metals markets will need more than occasional geopolitical flare-ups to drive a long-term bull market advance. The fundamentals are turning in favor of higher gold and silver prices, from fiscally reckless trillion-dollar deficits in Washington to a Federal Reserve obsessed with generating higher rates of inflation to mining supplies of gold and silver looking tight. The ingredients for a big bull market are in place. However, safe haven demand from investors has yet to pick up in a big way. We saw some this week, but it will likely be fleeting until the general public sees good reason to pull assets out of the stock market. As stocks hit record highs last year, gold and silver coin sales at the U.S. Mint plunged to multi-decade lows. The U.S. Mint sold just 152,000 ounces worth of gold American Eagles in 2019. That marks the lowest total on record going back to 1986. Meanwhile, sales of the silver American Eagle coins came in at their lowest level since 2007. Now, granted, a robust secondary market as a result of hordes of retail investors selling supplied the market with a cheaper alternative to the newly minted coins, and that explains part of those low numbers for the 2019 U.S. minted product. Australia's Perth Mint, however, saw an increase in coin demand from its more internationally based buyers. Many sought physical bullion as a refuge from negative interest rates in their home countries. As U.S. investors realize that they too face the prospect of negative real interest rates on savings and bubble valuations in equity markets, they too will increasingly find a compelling value proposition in gold and silver. Well, now for some predictions on what 2020 will look like for the metals and other markets, let's get right to this week's exclusive interview. It is my privilege now to welcome in Craig Hemke of the TF Metals Report. Craig is a well-known name in the metals industry and runs one of the most highly respected websites in our space and provides some of the best analysis you will find anywhere on banking schemes, global macroeconomics, and evidence of manipulation in the gold and silver markets. Happy New Year to you, Craig. Thanks for coming on and welcome. How are you?
Mike, it's always a pleasure. New Year's gotten off with a bang, man. I hope it's not indicative of how crazy this entire year is going to be. We'll see.
Yeah, certainly this week's market action itself, lots going on, both geopolitically and in the markets, and we'll get to a lot of that. Well, Craig, here we are entering another new year. The conflict with Iran and the potential for an escalation there spurred some safe haven buying in recent days, but the rally in metals started last month. I'd like to open by getting your thoughts on what you believe will be driving metals prices this year. Yes, we expect the forces of evil to continue doing their best to manage prices, and we'll get to that topic of price manipulation in a moment, but talk about what you're seeing in the metals here recently and discuss some of the themes you anticipate people will be talking about this year when it comes to the metals.
Well, I think it's critical that people try to have a longer memory than 48 hours. As we record this today, I'm seeing all kinds of garbage. I saw garbage from some group that is always a perma-bear, always talking about how gold is topped out and going down, has a clear agenda, just like some of the short sellers that are always anonymously pound the mining stocks, with fake research reports and stuff like that. And I'm seeing these things today about how, oh yeah, gold, look at that. Look how terrible that candle looks on the daily chart. And how come gold's not going up when, all this war stuff? And it's like, do you not understand? I mean, gold went up prior to the war starting, okay? Beginning last Thursday, gold closed on the COMEX last Thursday, January the 1st, at about 1530, okay? So the whole move from 1530 to 1580 was war premium, if you will, really short-term war premium. Then the spike to 1610 was when we seemed to be on the verge of what could even have been a nuclear war in the Middle East. The fact that it's pulled back to 1550 shouldn't surprise anybody. I mean, it hadn't even worked out all the war premium yet, despite what is some pretty cheery economic news this week. Service sector PMIs, the ADP jobs report, that kind of thing. So, geez Louise, I sure hope people keep their perspective. You are correct in pointing out, Mike, that the metals rallied strongly into year-end. It had nothing to do with war. That wasn't on anybody's mind prior to about 6 o'clock in the evening on January the 2nd. Gold rallied 3% from December the 20th through that date. Silver rallied 8.5% from December 9th at 1660 up to 1840 on January the 2nd. The HUI, the Gold Bugs Index, which everybody's freaking out because the shares went down yesterday, the HUI's up 15% still since the middle of October. For a while it was up 20. And why is this happening? Because the Fed, whether they want to call it QE or not, began this direct monetization of the debt program in October. Everything's going up. Stock market, you name it. And that is going to continue this year. It's only going to get worse. A lot of people missed last Friday, the 3rd, the minutes for the December Fed meeting were released. First of all, everybody's on vacation still on Friday, January the 3rd. And second of all, those are always released on a Wednesday, 3 weeks after the Fed meeting. So no one's looking for them on a Friday afternoon at 2 o'clock, but here they came. And buried within the minutes, anybody can pull these up, is an admission that what's very likely to happen in the months ahead is that the Fed will start monetizing not just T-bills, but notes, longer-term duration notes, 2 years, 3 years, 5 years, 7 years, 10 years. There's no other option. They cannot afford the stock market to go down. They cannot afford the money supply to contract. And thus, they will constantly be printing all through this year more and more dollars. And everything is going to go up for the reasons that were driving them last year. Please don't get caught up in what happened and how the chart looks based on these extraordinarily rare events that we saw back on Tuesday.
There's been a bit of a pattern in recent years where the metals start perking up in December and perform well in the first half of the year. Any thoughts about what's behind that, and are you looking for that pattern to repeat this year, Craig?
Yeah, we were talking about it on my side all the way through December. It was logical to expect, first in November, you expected the metals to trade lower because the December contract is always the most heavily traded all year long. And the December contract for both gold and silver had massive open interest, and they were both going off the board at the end of November, which meant all the speculators that were long were going to have to sell. And if they don't completely roll over their positions into February, the net effect is a selling pressure. Price went down. I told people all through November, I thought, 1440 ought to about do it. We're already so extremely oversold, I couldn't see a waterfall down. I think we saw 1445. I thought we'd rally into the end of the year because, as you said, Mike, that's typically been the pattern, especially since the bear market lows were put in back in 2015. The shares perform well, especially in the back half of December, because they're subject to so much tax loss selling, particularly in Canada. And that usually concludes around 18th, 20th. People want to get that done before they go on Christmas holiday. And so once again, we got that behind us and up went the metals. Let me just point this out too, Mike, because this is a lot like last year. You remember last year, stock market crashed. Remember that in December of 2018?
Sure, worst December in decades.
And it was crashing. And basically the stock market was catching down to the contraction of the money supply that the Fed was doing by trying to normalize, whatever that means, their balance sheet. And the stock market finally caught on to that disappearance of liquidity. And so what happened? On Christmas Eve, Mnuchin, anybody can look, I'm not making this stuff up, Mnuchin called a meeting of what's called the Plunge Protection Team, the President's Working Group on Financial Markets. They came up with a strategy to float it back higher. The day after Christmas, after the holiday, the Dow went up 1,000 points and never looked back. Now, this was when gold first started to move higher, was in December last year, because interest rates had peaked in November. And this is what all caused me to issue a forecast saying 19 was going to be the best year for the metals since 2010. Well, why? Because the Fed was going to be reversing course, and they were going to be printing cash because they don't have any choice but to liquefy and continue to liquefy all these markets. They can't have deflation. They can't have crashing stock markets. They can't have higher interest rates. None of that stuff. Okay? So in December of 2018, gold starts to rally. And everybody's like, well, this is just a safe haven deal. Gold's going to 1,100 in 2019, all the crap, Harry Dent stuff. Anyway, that's not what happened. It wasn't what was going to happen. It's not what did happen. And so now, here we are, gold rallying again, anticipating what's going to be happening this year. And it's the same thing. Well, the only reason gold went up is because of the safe haven stuff. As if gold rallying in December and the shares rallying since October had something to do with the idea that the U.S. was going to whack this Soleimani character on January the 2nd. It didn't have anything to do with that. Gold is just simply looking ahead, looking over the horizon as it always does, sees all this liquidity coming from the central banks around the world because it can't afford to do anything else, and it's moving higher. And people need to understand that, and they need to plan for that as they make their investment allocations for 2020.
Now let's talk about price manipulation. Nobody does a better job than you when it comes to covering what the crooked bankers are up to in the paper markets for gold and silver. They sold a boatload of futures contracts last year in both metals. You observed that open interest in gold was up a whopping 70%. Said another way, the supply of paper gold rose by 70%, yet the amount of gold in the vaults backing that paper barely budged. It's quite the racket. So while gold itself is actually scarce and hard to produce, futures contracts are exactly the opposite. The supply is essentially unlimited. Last year, 33 million new ounces of paper gold were dumped into the market. Despite that, gold prices still managed to rise by 18% or so. So what do you make of that?
Yeah, I mean, this is how the world, and I guess, I don't know, too many people, get their beaks dipped in this or just simply don't care. But how the world allows, how the mining companies allow their product to be priced not off of the exchange of the actual commodity, but off the exchange of these derivative contracts that have nothing to do with anything. It's like I look at you and I say, Mike, we'll call this contract between you and I gold. And I promise at some point that I got the gold behind it, and if you want it, I'll deliver it to you. And then you promise that you're actually interested in it, and you go borrow a bunch of money from your broker-dealer to buy it on margin. And then we just pretend that contract is actually, there's going to be some physical, exchange between us at some point. But that never happens. And at the end of the day, you just say, well, I like my exposure, and I sell my contract, you sell your contract, and I take on the other side of it, buy it back. And there was never any gold exchange at all. There was just some weird promise that there was a backing to it. And that's a trading of those things that is allowed to determine price. It's just ridiculous. Yeah, let's backtrack to that open interest thing that you said, because here's a great way to look at it. Everybody knows, or at least should know, that 2018 was the largest year of global central bank gold purchases since 1969, the year after the London gold pool failed, 651 metric tons. Projections are, run rates, I haven't seen the actual final numbers yet, but the projections are that 2019 was even greater, probably about 670 metric tons. So there is, 25% of global mine output actually demanded, I guess, as far as we can tell, physically delivered to the central bank, 670 metric tons of physical demand, offset by, as you said, the creation of over 1,000 metric tons of digital pretend paper gold, contracts. And it's like a two-headed monster. I mean, you've got the actual physical product, which, as you said, is scarce, being priced by the trading of derivatives, which can be created infinitely because no one ever calls any of these people to the carpet. So it's ridiculous. It's outlandish. Yes, gold managed to rise 18% last year, even while the supply of derivative contracts increased by 73%. Imagine if there was some forced linkage between the ability to create contracts and the amount of actual gold on deposit in the vaults. And you couldn't have increased it by 73%. What if the supply only increased by 10%? Well, then all that money around the planet looking for gold exposure would have had to find it through acquisition of existing contracts. This is how the stock market allegedly works, but that's not how it works in the pricing of precious metals. The banks just create more contracts, taking the opposite side, taking the short side, and figuring they can outlast the speculators, eventually maybe force them out and cover their shorts. It's disgusting. And again, at the end of the day, what's really astonishing are these dopey, rock-breaking geologist CEOs of the mining companies that think it's a valid pricing structure and they fall for it. That's what's really mind-blowing.
I want to ask you about the possibility of whether or not the bullion banks will lose control of prices anytime soon. That 70% jump in open interest is extraordinary. The Department of Justice is prosecuting several people, and they have secured some guilty pleas. It's interesting that they are using RICO laws. Perhaps they actually see the bank activity for what it truly is, organized crime. Officials in London are asking some pointed questions about the fraudulent use of EFPs, exchange for physical. An optimist would say that that some of these developments will lead to reforms, but I think we've all learned that you should never overestimate bureaucrats' ability or willingness to do the right thing. We may have to wait for the market to solve the problem, which will happen right after confidence in the futures markets, the banks, and or the dollar collapses. What are your thoughts about how much longer this crooked price discovery system will persist, Craig?
Well, Mike, you've said a mouthful there. Let me pick off a couple of things. You mentioned the regulatory agencies. You got the RICO investigations here in the U.S. It's pervasive. The fraud is pervasive. The former head of J.P. Morgan's precious metals desk, who is also on the board of the London Bullion Marketing Association, the LBMA. Why would he be on both, right? Why would he be a JPM trader and on the board at the LBMA? But anyway, he's now been indicted. The RICO statutes allow you to not just go after the goon, but allow you to go after the Don. Okay, so we'll see how far it reaches. However, it does reach across the pond. My friend Andy McGuire has been telling me this now for over a year, that the FCA, which is the English-British equivalent of the SEC, I guess, or Department of Justice, whatever, has been looking into the risks that are being taken by the English banks and what that might pose to the system. Andy has told me about a meeting he had with a couple of members of Parliament and this guy, Andrew Bailey, who at the time was the head of the FCA. This was back in maybe August. And this Bailey had no idea, because the LBMA is so opaque, right? I mean, you don't get these stats every day of all the unallocated gold and all the stuff and the risk that the bullion banks are taking there. So Andy laid it out for him, and he said, this guy's jaw dropped. And he's like, look, we can't afford a second financial crisis off of this. I mean, the people, we already shafted them once. They'll never let us get away with it again. We have to put a stop to this somehow. And Andy told him about, the EFPs, and we'll get to how that continues in a second. So anyway, this guy Bailey, who, according to Andy, said, we got to somehow put a stop to this. This guy Bailey was just nominated and confirmed to be the head of the Bank of England by Boris Johnson. So what's he going to do? Does the buck stop when he leaves there? It leaves the FCA, and now he's got to, be a servant to the Bank of England and, and stop paying attention? Or maybe he's going to call the banks on the carpet. I know what direction I think any cynical or non-cynical person would think that that's going to go, but I digress. These EFPs that I've been writing about for a couple of years, this is an arcane process that's a part of every futures market, but it is, I just can't even describe the degrees to which it is abused, I guess that's the right word, within gold and silver. I've kept track of, I don't even know what it is, over the last 2 years, something like 14,000 metric tons of gold contracts. Each COMEX gold contract is 100 ounces, allegedly, of gold. Well, enough contracts that are the equivalent of 14,000 metric tons have been moved off the COMEX and exchanged for physical EFP through London. Andy says that's just, they have this process where they swing them into these 13-day little contracts that are off the books and just keep rolling them over and over and over, trying to make it, kind of hide it and pretend that it's not there. But this process continues. Mike, let me lay this on you. We've had, as we speak, 5 trading days in the year 2020. In those 5 trading days, there have already been 67,713 COMEX contracts shifted off of the exchange and exchanged for physical, as they say, again, in London. 67,000. Like, again, every contract is 100 ounces. That's 6.7 million ounces. That's 210 metric tons of gold. I mean, the whole COMEX vaults only hold 8 million ounces, and they shifted 210 metric tons, 6.7 million ounces off exchange in just 5 days. This is the scam of the greatest order. And like I said, again, the amazing thing is that it still exists. And people in 2020, when the world is all interconnected and everybody knows everything, and I can watch missiles take off in Iran 5 minutes after they're shot just by following Twitter. It's amazing that this continues. It's just mind-boggling that this is allowed to continue.
Yeah, well put. You beat your head against the wall trying to figure out how, when it's going to finally end and why there's not more talk about it. Well, Craig, before we wrap up, I'd like to get any final thoughts. I know you've got a lot to say here early in the year. If you could give metals investors an idea of what it is that you're going to be watching most closely, what they should be watching most closely over these first few months of the year, and then maybe a sign that perhaps the powers that be are losing control, or any other comments you want to make here as we wrap up.
Yeah, I don't know, Mike. Since I've been doing this, and I have to admit, kind of falling forward a little bit and getting excited about it myself back in 2009 and 10, that kind of thing. This hyperbole of, the COMEX is going to fail. Come on. That'll all happen in a blink of an eye or someday or, overnight. But to sit there, these people that say it's going to fail above $22 silver, come on. We'll see. The banks are going to keep it going as long as they possibly can. And I don't think anybody can come up with a timetable for it. The only thing that'll end it, is like a run on the banks for physical metal, and this kind of thing gains momentum and it snowballs, and finally that realization of what a scam it all is sinks in, and people panic to get their hands on actual metal while they can. Again, I just can't stress this enough. Ignore the perma-bears with an agenda. They're trying to talk down the market or trying to talk down the shares or trying to talk down the individual shares because they have some massive short position. The Fed is going to continue with the repo crisis. It's not going away. The U.S. is going to have at least a $1.2 trillion deficit every year this decade. That's what the Congressional Budget Office says. That money's got to come from somewhere. The central banks cannot afford a deflationary collapse. They will be printing and printing and printing. Even absent that argument about what that does to the dollar and all this other stuff, that cash goes someplace, and it goes everywhere. Again, it's not a mistake that the HUI's was up 20% since October 15th. It's now up 15%. What happened on October 15th? That's when this whole new not QE debt monetization program kicked in. Everything's going up, okay? So everything's going to continue to go up. Now, the banks are going to throw up roadblocks. We've already got 800,000 contracts of open interest in COMEX gold. So I don't know how far gold will go. 1650. Maybe if it kind of gets rolling, it can go to 1750 this year. That'd be a pretty good year from where we are. But where I think the real interest should be for people that want to either have some fun, make some trading fiat, currency that then they can buy more physical metal, that kind of thing. Start looking into whether or not you have exposure to the mining shares, not just the big companies, but the medium juniors, some explorers, that kind of stuff. Because as the global asset managers, have all this cash, and they're always looking for a place to go. But once the GDX, the GDXJ, the HUI begin to make new highs versus 2016, the floodgates are going to open, and money's going to come pouring into the sector. And it all has to pass through like a little tiny funnel because there's only so many places it can go. And it's just simple economics. You get twice the cash chasing the same handful of stocks, and they're going to go up in price. So I think it's going to be a very good year, again, for the metals, just like last year was, and I was right when I said, predicted it last year. But I think the real outsized gains will probably be in the shares more than in the physical metal. I wrote that up. I kind of make an annual forecast every January. I post it to my site. It's a free link. Maybe I'll send it to you, Mike. You can put it on this page. I always try to come up with a catchy name. And so this year's title is 2020 Foresight instead of 2020 Hindsight. Kind of clever, huh? Yeah. Thanks. 2020 Foresight is what it's called. You can go to my site, or like I said, click the link if you can put it on this page. And it'll just explain to you the basis for why I think it's going to be a good year. I invite, if you got time, I think it's worth a read.
Yeah, it would be time well spent for sure. I always say we spend a lot of time looking at your site here in this office. It's money well spent for anybody that wants to get on board there with TF Metals Report. And before we let you go here, Craig, tell people a little bit more about your site, how they can get signed up, and maybe some other tidbits they should know.
Well, really the best thing about my site, I do analysis every day, and we try to keep people locked in and to the big picture, not the tick-by-tick stuff. But the site is, the people that populate it are from all around the world, all different political views, but we realize we're all in the same boat. And so instead of bickering at each other and name-calling and all that kind of stuff, we're rule number 7 in the community guidelines is treat others the way you want to be treated, right? And that's, I mean, come on, your mother taught you that. You know, why do you think just because it's an anonymous website you can be rude and mean, like at Twitter, things like that? So anyway, the community itself is what's worth it. It's only $12 a month, so it's not like, you know, I'm getting rich off of it. 40 cents a day to give you access, really keep you on top and grounded of where we're headed. And again, I just can't emphasize enough. I mean, Mike, the old line is a rising tide lifts all boats, right? Think of the rising tide being all of the cash that has to be created from nothing. You must understand, this is direct monetization of the debt by the Fed. Primary dealers they get the treasury bills, soon to be treasury notes, from the treasury. The primary dealers are the ones responsible for making that market and getting them filled. They buy them themselves, and anybody can. Zero Hedge's been great about writing this. The Fed then buys these directly from the primary dealers about 72 hours later. Okay, so there's an intermediary in between, but basically the Fed is buying the treasury bills, soon to be notes, directly from the treasury. How that isn't direct monetization of the debt, I don't know. Just because there's a step in between? So this is happening. Modern monetary theory, all that stuff that the politicians daydream about, that's coming. And whether you want to talk about gold standard and system reset and all that kind of stuff, whatever, yeah, sure. But all of that cash is going to be sloshing around. Stock market's going to go up, everything. So gold and silver are going to go up. And the shares are going to be particularly advantageous to own in the next few months. And so I just want to keep everybody grounded and not be thinking about the events of Tuesday. And, I mean, that was a real, you want to talk about one-off, that was a one-off. That was hopefully something that we'll never see again in your lifetime, this on the brink of maybe nuclear war in the Middle East. Ignore the reaction to it, the run-up to it, and look at the bigger picture, and I think you'll see that physical gold and silver and maybe some mining shares must be a part of a portfolio in 2020 going forward.
Yeah, well put. It's going to be a great time to kind of focus more on this if you're not already doing that, and it's going to be an interesting, maybe tumultuous year. Ignore the blips or don't pay as much attention to them. We do have a trend in place here, and Craig and TF Metals Report is a great way to follow that, hopefully right here on this podcast as well. Well, very good. Thanks again, Craig. Have a great weekend. I wish you a happy and prosperous new year, and we look forward to catching up with you again soon. Keep up the good work, my friend.
All the best, Mike. Go Chiefs.
Yeah, good luck to your Chiefs this weekend. Well, that will do it for this week. Thanks again to Craig Hemke. The site is tfmetalsreport.com. Definitely a fantastic source for all things precious metals and a whole lot more. We urge everyone to check that out if you haven't already done so, for some of the very best commentary and analysis on the metals markets that you will find anywhere. And be sure to check back here next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.